Truthfully, the IRS isn't as heartless as everybody makes them out to be. Unfortunately, the US tax code can be. And one spot we find that, the widow penalty. Hi, Kevin Gaines, AFMG. And the widow penalty is this concept. It's not an official designation or anything, but it's something a lot of us advisors like to say or label it as. What happens is when you lose your spouse, your income's probably going to drop a little bit. You're going to lose some of your Social Security benefits, maybe a third, maybe up to a half. If you're collecting a pension, it'll probably go down a little bit, depending on which option you elected, but again, no more than 50% at the very most, typically. But retirement accounts, which is a significant amount of savings for most of us, they don't go down at all. Quick example, you have a $500,000 401k and your spouse has a $500,000 IRA. Well, when he or she dies, that $500,000 comes to you. So you now have $1 million of retirement account value. And you have to take money from there. Once you reach, at the moment, 72, maybe it changes down the road, but for the purpose of this video, it's 72, you have to start taking your required minimum distributions. Well, when you have an account of 500,000, that distribution may have been, say, 25,000 or 50,000, depending on your age. Well, now that you have $1 million, that required distribution has doubled. So you're still taking this same amount of income from these retirement accounts, but you're now in higher tax brackets. And what do I mean by higher tax brackets? Well, let me show you. This is for 2022, the income tax brackets that we're all dealing with. Here on the left, married filing jointly. On the right, if you're single. And you'll see that the limits for each tax rate are half of the joint for single taxpayers. So 10%, if you're married filing joint, anything under $20,550 is 10%. For a single, 10,275. It's half. Yes, down here at the highest tax brackets, it's not quite half anymore. The numbers can change, but for most of us, it's going to be half. And real quick with these tax brackets, as you earn more money, you move up into the tax brackets, but the dollars that fall within the lower tax brackets, you're still paying that rate. So for example, everybody who earns $30,000, if they're married filing joint, the first $20,550, you're paying 10% on. It's the amount over that that then moves up to 12. And then if you earn more than 83.5, you move into the 22 and those dollars move up. And that's going to be key for what we're talking about, to understand or to at least minimize the stress that you might feel. Because your income drops a little bit, but as you'll see that the tax brackets drop even faster. So real quick, think of, look here at the 24% tax bracket. Let's pretend you and your spouse are earning $275,000. So here you are in the 24% tax bracket. Your partner dies and your income goes from 275 down to 225. Well, now if we look over here, you're no longer paying 24% on those higher dollars. You're not even paying 32%. Those last few dollars, you're paying 35% on. So that could be, that can generate quite a hefty bill. Now, you may say, well, Kevin, that's all well and good, but I don't have that kind of money. Even in our best, we never earned that much money. So are you trying to say that this is a rich people problem? Not necessarily. Let me show you another example here. So let's pretend that you don't earn $275,000. Let's say you only earn $83,000. Okay. You're living a comfortable life. You're paying 12% on these dollars. Okay. Then the unfortunate happens. One of you passes. Income drops to say 70,000. Frankly, we could even say 65,000, or as you'll see, 41,000 here in a moment. What happens to your taxes? Well, you were paying 12% on most of your money, but now all of a sudden you jump up to the 22% tax bracket. And it's like, gee, okay, that's a jump. Here's another way to phrase it even more painfully. Yes, it went up 10 percentage points, but that's essentially a doubling. You move from 12 to 22. You've almost doubled your tax rate that you're paying on a significant portion of your money. So the widow penalty can hit anywhere. It just depends on the dollars and where you fall within the tax brackets. I wish I could say that there was an easy solution to this. There isn't necessarily, but there are a couple things you can look at that might help, which are, tax-free accounts. Now, IRAs are tax deferred, 401ks are tax deferred. But what about Roth IRAs, Roth 401ks? That money is, once you put it in, that money's not coming, you're not paying taxes on that. Health savings accounts, HSAs, they're really good for tax-free distributions. And this is money that you can use, multitude of ways that you would normally be spending anyway. So this could help keep the tax rates, your taxable income, lower. You can also think about products with death benefits, such as life insurance or annuities, that when you die, your beneficiary, that lump sum amount is going to be tax-free. Now, yes, that money, if you invest it, it's going to earn something, hopefully, and those earnings would be taxed. But, the lump sum amount, that's another source of funds that you could use to help mitigate the damage that, or not so much damage, mitigate the pain of the widow penalty of, going into this higher tax bracket. Thank you for listening. Kevin Gaines, AFMG. If you enjoyed this video, please subscribe below. Check out our other videos, as well as our website, afmgplanning.com. And maybe what you might find even more informative, our podcast, Take Back Retirement, in which we spend a lot of time talking about these issues and other things that hopefully will allow you to have a better and happier retirement. So until next time, thank you.